This is Jillian Verdun from JMV Financial Services, your profit strategist, bringing tips and tricks to improve your financial situation for the new year. I'd like to thank you again for joining me today. What we get to talk about is bad debt. What is it? And can you write it off? I've had several people reach out to me in regards to bad debt of individuals who are not paying them. And they want to know, can they write it off on their taxes? We all know being in business is hard work, especially if your business is overrun with bad debt and high taxes. Sometimes you have clients or customers that will not pay you for services or products that you've provided. Okay. Now, what is considered a bad debt? Bad debt or an uncollectible account is a receivable owed by a customer, client, or patient which the business owner or creditor is not able to collect. Bad debts may be written off by the creditor at the end of the year if it is determined that the debt is uncollectible. However, the IRS says bad debt includes loans to clients and suppliers, credit sales to customers, and business loan guarantees. The ultimate question is how to write them off. Bad debts are taken off of the business income at the end of a year. In order to write off bad debt, your business must use what we like to call accrual accounting method. And you're like, what does that mean? Under this method, you show income when you have billed for it and not when you collect the money. Majority of small businesses operate on what we call a cash accounting basis, which means you cannot deduct bad debt because in cash accounting, you don't record the income until you have received the payment. In this case, you just don't receive the income, so there is no tax benefit to recording a bad debt. Under the accrual method, if I provide a service to you, and I invoice you for that service and you choose not to pay me. When I file my taxes, if I include your invoice in my income, I can write off your bad debt. If I invoice you and you still don't pay me, but I don't record your income that year for taxes, then I get no tax benefit to recording that bad debt. So then the answer ultimately is no. So, for example, let's say you sell $100 service to a customer. Under the cash accounting method, you only record the sale when you receive the money from the customer. If the customer doesn't pay, you don't record the sale. So at the end of the year, you haven't been able to collect the money. There's no bad debt because there was no sale recorded. Under accrual method, you record the sale at the time you billed the customer. So your sales record for the year includes that $100. If you determine that you're not going to collect that $100, then you must manually take that amount out of your sales before you prepare your business tax return. So everybody always wants to know, how do you take bad debt off your business tax returns? You have to run your business on accrual accounting method to be eligible to take deductions for bad debt losses. Majority of people do not want to pay taxes on money they have not collected yet. Hence why they give you the option of recording using the cash accounting method. So what it all comes down to is if you choose to pay taxes on income that you have not received yet, but you've performed the service and billed the customer, then yes, you can take bad debt. If you choose to record and pay taxes on money that you've only collected in the form of cash or cash equivalent, then there is no bad debt to be recorded. So I hope this helps clarify a lot because I get a lot of questions in this regard, especially when it comes to small business owners. So we would like to thank you again for listening to us today, and please follow us on your favorite podcast. Bye.